Hey everyone, welcome back to Corporate Decoder. Today, P.L.M.K Acquisition Corp. IV or P.L.M.K just filed a Form 8K announcing an amendment to their Articles of Incorporation to extend their deadline to find a business combination, and there is a lot of dilution happening that I want to discuss. Quick note, this is not financial advice, just my take on public filings for educational purposes. Basically, the company is getting more time to find a merger, but a huge chunk of shares are being redeemed, and some insiders are converting their shares in a way that might be a bit concerning. So what we are looking at here is a current report, a Form 8, which companies file when they have important events to report that shareholders need to know about right away. In this case, the big news is all about extending the clock, Plum Acquisition Corp. IV is a special purpose acquisition company, or SPAC. These companies raise money through an IPO with the sole purpose of acquiring another company. They typically have about 2 years to do this, and if they don't, they usually have to give the money back to the investors. Plum is one of those companies that is running out of time. Their original deadline to find a business to merge with was the 16th of July 2026, but they held a shareholder meeting on the 10th of July 2026 and got approval to extend that deadline. Now, they have until the 16th of January 2027 to get a deal done. This extension gives them more breathing room, which is common for SPACs that are struggling to find a target or finalize a deal. But here is where it gets interesting. This amendment allows them to extend the deadline even further, on a monthly basis up to 6 times after that initial January extension. This means they could potentially have until the 16th of July 2027 to complete a business combination. This is a significant extension and tells us they are likely facing challenges in finding and closing a deal. Companies that are confident in their merger prospects usually do not need so many extensions. Now, let's talk about the shareholders. When SPACs extend their deadlines, it often comes at a cost to existing shareholders. In this filing, we see that holders of a large number of shares, specifically 135,403,84 public shares, decided to redeem their shares. Redeeming means they asked for their money back instead of waiting for a business combination. At a redemption price of about $10.71 per S-share. This amounts to approximately $145 million being pulled out of the company. Think about that. That is a massive amount of money leaving the company. Plum had about $184.7 million in their trust account originally, and now there is only about $39.7 million left. This is a huge reduction in capital. When a SPAC has less money in its trust account, it makes it harder to fund the acquisition and can also signal to potential merger targets that the SPAC has less financial firepower. This could lead to less favorable terms for the SPAC in any future deal. Adding to this, the sponsor and the company's independent directors voluntarily converted a lot of their Class B shares into Class A shares. They converted nearly 5.8 million Class B shares into Class A shares. Class B shares are typically held by insiders and founders and often have more voting power. By converting them to Class A shares, which are the ones that public investors hold, it can sometimes be done to make the share structure more palatable for a merger or to comply with listing rules. However, the key point here is that these converted shares will not be entitled to receive funds from the trust account through redemptions. This means that while the total number of Class A shares outstanding increases, the cash available per share for the remaining shareholders decreases even further due to the redemptions. After all these redemptions and conversions, Plum is about 10.7 million Class A shares and just one Class B share. This significantly dilutes the value for any remaining shareholders who did not redeem. For instance, if you are holding shares before these events, your proportional ownership in the company has effectively decreased because more shares are now outstanding. And importantly, the cash available to back those shares has drastically reduced. This is a common pattern in SPACs facing difficulties, and it often leads to a much lower valuation in any eventual merger. Many SPACs that go through extensive extensions and significant redemptions end up with very unfavorable merger terms or simply fail to complete a deal. Let's look at how the shareholders voted on this extension. The meeting had to have a quorum, meaning enough shareholders needed to be there, either in person or by proxy, to make the vote valid. In this case, about 81.32% of the voting power was represented, which is a strong turnout and more than enough for a quorum. The proposal to extend the deadline passed with a significant majority of votes. Out of over 19.7 million shares voted, 17.6 million voted in favour of the extension. This indicates that most of the remaining shareholders understand the need for more time, likely hoping for a successful merger despite the redemptions. There were 2.1 million votes against the extension, and a very small number of abstentions, showing some dissent but clearly not enough to block the move. Looking at external context, Plum Acquisition Corp IV and its ticker PLMK have been trading with some volatility. Its current price is around its 52-week high, trading at $11.5, but the price range suggests it has seen some fluctuations. Recent news mentioned an amendment to a business combination agreement with Controlled Thermal Resources Holdings Inc., which may or may not be related to this current filing, but it shows they are actively pursuing deals. However, the significant redemptions we are seeing here are a red flag. When nearly $145 million is redeemed, it really puts the company's ability to complete a deal in question. Historically, many SPACs that experience such high redemption rates struggle to find a merger partner on favourable terms, and some end up liquidating, returning the remaining capital to shareholders and effectively shutting down. For example, many micro-cap SPACs that go through multiple extensions and heavy redemptions see their stock price falter significantly after any announced merger, if one is even completed. A historical comparison could be companies like Cowen Inc., which, after various recapitalizations and struggles, eventually saw its business acquired at a low valuation. While this isn't a direct comparison to a SPAC, the pattern of capital leaving the company and the struggle to find a sustainable business path is similar. The company's registered securities include units, Class A ordinary shares, and warrants. These are the typical components of a SPAC offering. The units themselves are made up of one class of share and a half of a redeemable warrant. The class of shares are what public investors buy, and the warrants give the holder the right to buy more shares at a later date. The exercise price for these warrants is $11.5, which is exactly the current trading price you see for P.L.M.K. This means that if the company does announce a merger and the stock price stays at or above $11.5, warrants could potentially be exercised, leading to further dilution for existing shareholders. So, what does all of this mean? Plum Acquisition Corp IV has bought themselves more time to find a merger, but it came at the cost of a massive outflow of cash due to redemptions. This leaves them with significantly less capital to work with, making any future deal harder to negotiate and potentially less attractive for shareholders who remain. The conversion of Class B shares to Class A also means more shares are out there, further diluting the remaining shareholders' stake. The biggest risk I am watching is the remaining capital in the trust account. With only about $39.7 million left, Plum IV will need to find a very cheap acquisition or bring in additional funding for any merger to be successful. If they can't find a deal that justifies the remaining capital and potential future dilution from warrants, they might face liquidation. My biggest concern is that this extension is just delaying the inevitable for shareholders who haven't redeemed yet. What I am actually looking for is any news about a definitive merger agreement. And I will be scrutinizing the terms very closely, especially the valuation and expected dilution. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.